Is the AI boom about to bust? That's the question on investors' minds as leading AI stocks took a hit, sparking jitters across the market. But don't panic just yet. Here's a breakdown of what's happening and what to watch for. Thursday night saw stock futures inching upwards, a slight rebound after a day of losses for U.S. equities. Futures tied to the Dow Jones Industrial Average are up approximately 95 points, a roughly 0.2% increase. Similarly, both SP futures and Nasdaq 100 futures experienced gains of about 0.3%. This suggests a tentative optimism is returning to the market after a shaky session. So what triggered the initial downturn? Key players in the artificial intelligence sector, like Nvidia, Advanced Micro Devices, AMD, Tesla, and Microsoft, all saw their stock prices dip significantly. This pullback in these high-profile tech names put downward pressure on the broader market. But here's where it gets controversial. Some analysts believe this isn't a sign of a fundamental problem with AI, but rather a healthy correction after a period of explosive growth. Adding fuel to the fire, recent data revealed a concerning trend. Job cuts in October reached their highest level for the month in over 2 decades. In fact, 2025 is shaping up to be the worst year for layoffs since the financial crisis of 2009. This news undoubtedly contributed to investor unease, further accelerating the stock declines. The rise in job cuts highlights a potential disconnect between the optimism surrounding AI and the realities faced by workers. It also raises questions about the widespread adoption of AI and its potential impact on employment across various sectors. Is this a temporary blip or a sign of deeper economic issues? That's what everyone is trying to figure out. Across the board, major U.S. stock averages ended the previous session in the red. The tech-heavy Nasdaq Composite took a particularly hard hit, plummeting by 1.9%, while the Dow Jones Industrial Average fell by nearly 400 points. This widespread decline underscores the interconnectedness of the market, where the performance of key sectors like technology can significantly impact overall indices. Looking at the week as a whole, the 3 benchmark indices are all currently showing losses. These losses have been accumulating since Tuesday, largely driven by those valuation fears surrounding major AI stocks. This has led to what some experts call a highly concentrated market, where a small number of companies exert a disproportionate influence on overall market performance. The S&P 500 is down 1.8% week to date, while the Dow Jones Industrial Average and Nasdaq has lost nearly 1.4% and 2.8% respectively. And this is the part most people miss. A concentrated market can amplify both gains and losses. When a few big players stumble, the entire market feels it more acutely. However, not everyone is sounding the alarm. Some market participants remain cautiously optimistic, pinning their hopes on a few potential catalysts. The end of the ongoing U.S. government shutdown and a possible interest rate cut by the Federal Reserve in December could provide much-needed relief to U.S. stocks. Investors are also closely watching the Supreme Court's apparent skepticism regarding the legality of President Trump's sweeping tariffs and how third-quarter corporate earnings are progressing. These factors could significantly influence market sentiment in the coming weeks. According to Louis Navellier, founder and chief investment officer at Navellier Associates, there's still hope for a year-end rally once the government shutdown ends and the tariff situation is resolved. We are still 2 weeks from the very important Nvidia earnings, and strength there might be the catalyst to reaffirm the AI narrative. If that is followed by a December Fed cut, we may still go out on a high at year's end. Corrections with these levels of gains are normal and to be expected, not something to panic over. Navellier's perspective offers a valuable counterpoint, suggesting that the current market turbulence may be a temporary and necessary adjustment after a period of significant gains. Normally, the Bureau of Labor Statistics would release the non-farm payrolls report on Friday. However, for the second consecutive month, the report is delayed due to the government shutdown, Economists surveyed by Dow Jones had anticipated the report would reveal a decline of 60,000 jobs and an increase in the unemployment rate to 4.5%. The absence of this crucial economic data further complicates the market's ability to assess the overall health of the economy. Tesla shareholders approve Musk's massive pay package. In other news, Tesla announced that shareholders have approved CEO Elon Musk's almost $1 trillion pay plan, with 75% of voting shares in support. This decision was revealed at the company's annual shareholders meeting in Austin, Texas. A separate proposal concerning Tesla's potential investment in xAI, Musk's AI startup aimed at competing with OpenAI, received more votes in favor than against, but the results remain inconclusive at this time. Musk's pay package consists of 12 tranches of shares, which will be granted if Tesla achieves specific milestones over the next decade. This arrangement would also give Musk increased voting power within the company, fulfilling demands he has publicly expressed since early 2024. His ownership stake would increase from approximately 13% to 25%, adding over 423 million shares to his holdings. The first tranche of stock is triggered when Tesla reaches a market capitalization of $2 trillion. Currently, Tesla's market cap stands at $1.54 trillion. This move has sparked debate. Is this an appropriate incentive for a CEO or an excessive reward? Some argue it aligns Musk's interests with shareholders, while others criticize the sheer scale of the compensation. Tesla shares experienced a slight increase of roughly 0.2% in extended trading on Thursday. Year-to-date, the stock is up 10.4%. After-hours movers: Airbnb, Peloton, Take-Two Interactive, and more. Several companies made headlines in after-hours trading. Take-Two Interactive Software. Shares of the video game developer plummeted 7% after Rockstar Games, a subsidiary of Take-Two, announced a further delay in the release of Grand Theft Auto 6, pushing the launch date to November 2026 from May 2026. This marks the second delay for the highly anticipated game. This delay could be viewed as a negative sign for the company's future growth, or as a sign that Rockstar is dedicated to making the best game possible and won't release it until it's perfect. What do you think? Airbnb. Shares of Airbnb surged about 5% in extended trading after the company reported strong third-quarter results and guidance. Airbnb reported earnings of $2.21 per share on revenue of $4.1 billion, exceeding analysts' expectations. For the fourth quarter, Airbnb anticipates revenue of $2.66 billion to $2.72 billion, surpassing the $2.67 billion analysts were projecting. Affirm. Shares jumped more than 12% in extended trading after the company surpassed expectations on both top and bottom lines, with quarterly gross merchandise volume exceeding street forecasts. The fintech firm reported earnings of 23 cents per share in the fiscal first quarter and revenue of $933 million, beating analysts' projections. DraftKings, the sports gambling stock, declined nearly 4% following disappointing third-quarter results. DraftKings reported a loss of 52 cents per share, exceeding analysts' forecasted loss of 42 cents per share. Revenue of $1.14 billion for the period also fell short of analysts' consensus expectation of $1.22 billion. So, there you have it, a roller coaster of a day in the market. Are you buying the dip in AI stocks or staying on the sidelines? Do you think Musk's pay package is justified? Let us know your thoughts in the comments below.